Germany's bond market stands at a pivotal moment in 2026, with the federal government planning to issue approximately 512 billion euros in debt securities throughout the year. This figure represents one of the largest borrowing programs in German history and signals a fundamental shift in how Europe's largest economy finances itself amid evolving fiscal priorities, defense spending requirements, infrastructure modernization needs, and the complexities of managing a maturing debt portfolio in an environment where interest rates remain structurally higher than the previous decade. The German Federal Finance Agency, known as the Bundesrepublik Deutschland Finanzagentur, has outlined an issuance calendar that includes the introduction of a new 20-year benchmark bond, a maturity segment that fills a strategic gap in the yield curve between the 10-year Bund, which serves as the European benchmark for medium-term rates, and the 30-year Bund that anchors the long end of the curve. This new instrument is not merely a technical addition to the debt management toolkit, but reflects deeper considerations about investor demand, liability matching needs of pension funds and insurance companies, and Germany's desire to maintain its status as the provider of the most liquid and reliable sovereign debt instruments in the Eurozone. To understand why this issuance plan matters globally, we must first examine the structural role that German government bonds, collectively known as Bunds, play in international financial markets. Bunds serve as the risk-free rate benchmark for the entire Eurozone, meaning that all other European sovereign debt, corporate bonds, and derivative instruments are priced relative to German yields. When Italy, Spain, France, or any other Eurozone member issues debt, investors compare the yield offered to the equivalent German maturity and demand a spread that compensates for the perceived additional risk. This spread, measured in basis points, fluctuates based on fiscal conditions, political stability, and economic performance, but the Bund rate itself forms the foundation of this pricing mechanism. The 512 billion euro issuance target for 2026 compares to approximately 470 billion euros issued in 2025 and represents an increase driven by several factors. Germany's constitutional debt brake, enshrined in the Basic Law since 2009, limits the federal structural deficit to 0.35% of gross domestic product under normal circumstances. However, recent political developments have led to discussions about reforming or temporarily suspending this rule to accommodate increased spending on defense, following commitments made at NATO summits to reach the 2% of GDP threshold for military expenditure, as well as investments in renewable energy infrastructure, digital transformation, and upgrading transportation networks that have suffered from years of underinvestment. The breakdown of the 512 billion euro program includes both gross issuance and refinancing of maturing debt. Approximately 180 billion euros will cover redemptions of bonds reaching maturity in 2026, while the remaining 332 billion euros represents net new borrowing to finance the federal budget deficit and pre-financing activities for future years. This pre-financing strategy, which involves issuing debt ahead of immediate needs to take advantage of favorable market conditions and ensure smooth funding throughout the year, has become a standard practice among sophisticated debt management agencies and provides a buffer against potential market disruptions. The introduction of the 20-year benchmark bond deserves particular attention because it addresses a specific structural demand in fixed income markets. Insurance companies and pension funds, especially those in Germany, the Netherlands, and the Nordic countries, face long-duration liabilities extending 20 to 30 years into the future. These institutions must match their assets with their liabilities to minimize interest rate risk, a practice known as asset liability management. While 10-year bunds provide exposure to medium-term rates and 30-year bunds offer very long duration, the 20-year maturity sits in a sweet spot for many liability profiles. Prior to this new benchmark, investors seeking 20-year German exposure had to use less liquid off-the-run bonds or construct synthetic positions using interest rate swaps, which carry counterparty risk and basis risk. The Federal Finance Agency typically builds benchmark bonds through a series of regular auctions over several quarters, gradually increasing the outstanding amount until the security reaches benchmark status, generally defined as at least 20 billion euros in circulation. This size ensures sufficient liquidity for secondary market trading and repo transactions. The repo market, where bonds are used as collateral for short-term borrowing, is critical to the functioning of financial markets because it allows banks hedge funds, and other institutions to finance their bond holdings and execute trading strategies. German bonds are the most sought-after collateral in European repo markets due to their credit quality and liquidity, trading at special repo rates that reflect their scarcity value. Market data from the European Central Bank and Bloomberg indicates that as of early 2026, the 10-year Bund yield trades around 2.4%, reflecting the normalization of monetary policy following the aggressive tightening cycle that began in 2022, when the ECB raised its deposit facility rate from negative 0.5% to a peak of 4% by mid-2023. Although the ECB has since reduced rates modestly to 3.25% as inflation returned closer to the 2% target, real interest rates, which adjust for inflation, remain positive for the first time in over a decade. This environment fundamentally changes the calculus for debt issuance because the German government now pays positive real borrowing costs rather than being paid to borrow, as was the case during the negative yield era from 2015 to 2022. The fiscal implications are substantial. Every percentage point increase in average borrowing costs translates to billions of euros in additional interest expenditure over time as the debt stock rolls over. Germany's federal debt stood at approximately 2,400 billion euros at the end of 2025, representing roughly 62% of GDP, up from around 59% in 2019 before the pandemic. While this ratio remains among the lowest in the developed world and well below the 95% average for advanced economies calculated by the International Monetary Fund, the trajectory is rising, and the debt service burden will increase as older bonds issued at zero or negative rates mature and are replaced with securities yielding 2 to 3%. For investors, both institutional and individual, understanding the German issuance outlook provides insights into supply-demand dynamics that drive yields and relative value across fixed income markets. When a major sovereign increases debt issuance, basic economics suggests that prices should fall and yields should rise, all else equal, because buyers require higher returns to absorb the additional supply. However, this relationship is complicated by central bank policy, global savings patterns, and risk appetite. If the ECB is simultaneously reducing its balance sheet through quantitative tightening, allowing bonds to mature without reinvestment, this removes a significant source of demand and amplifies the effect of increased government supply. The ECB's asset purchase program, which accumulated roughly 5 trillion euros of securities during the 2015 to 2022 period, provided massive artificial demand that suppressed yields. As this process reverses, yields face upward pressure. Conversely, if global investors perceive increased geopolitical risk, economic uncertainty, or financial instability, demand for safe haven assets like German bonds increases, which can offset the impact of higher supply. The flight to quality phenomenon has been observed repeatedly during crises, from the 2011 Eurozone sovereign debt crisis to the March 2020 pandemic panic to the October 2022 UK gilt crisis. During these episodes, German yields fell even as the government increased borrowing because investors prioritized capital preservation over yield. The strategic importance of the new 20-year benchmark extends beyond German borders because it provides a pricing reference for corporate and financial issuers seeking to raise long-term capital. When a European corporation wants to issue a 20-year bond, investment banks will price the offering at a spread over the German 20-year yield rather than interpolating between the 10-year and 30-year maturities. This direct benchmark reduces pricing uncertainty and potentially lowers borrowing costs for issuers while giving investors a clear hedging instrument. The development of a liquid 20-year Bund market also enhances the functioning of interest rate swaps and derivatives markets, where market makers hedge their positions using government bonds. From a risk management perspective, investors considering German bonds must evaluate interest rate risk, inflation risk, currency risk for non-euro investors, and reinvestment risk. Interest rate risk, measured by duration, indicates how much a bond's price will change for a given move in yields. A 20-year Bund with a duration of approximately 15 years would lose 15% of its value if yields rise by 1 percentage point. This sensitivity makes long-duration bonds volatile in price terms, even though they are credit risk-free. Investors must assess whether they can hold to maturity or whether they might need to sell before maturity, potentially realizing a loss. Inflation risk has returned to prominence after years of dormancy. The Eurozone experienced inflation rates above 10% in late 2022, the highest since the introduction of the euro, driven by energy price shocks following the Russian invasion of Ukraine, supply chain disruptions, and fiscal stimulus. Although inflation has declined to around 2.5% in early 2026, the risk of renewed price pressures from wage growth, geopolitical tensions, or commodity shocks remains. Nominal German bonds offer no explicit inflation protection, meaning that if inflation averages 3% over the life of a bond yielding 2.4%, the real return is negative. Germany does issue inflation-linked bonds, known as Bund, which adjust principal based on Eurozone CPI, providing direct inflation protection, but these trade at lower nominal yields and represent a smaller portion of total issuance. Currency risk affects international investors, particularly those from the United States, United Kingdom, Japan, and China, who represent significant buyers of German debt. A US-based pension fund purchasing bunds earns the euro yield but faces the risk that the euro depreciates against the dollar over the holding period, reducing dollar-denominated returns. Currency hedging using forward contracts or cross-currency swaps can eliminate this risk, but incurs costs that reduce the net yield. The decision to hedge depends on the investor's base currency, their views on exchange rate movements, and the cost of hedging, which fluctuates based on interest rate differentials between currencies. Reinvestment risk applies to investors who depend on coupon income and must reinvest those payments over time. If interest rates fall after purchasing a bond, the coupons will be reinvested at lower rates, reducing total return. Conversely, if rates rise, reinvestment occurs at higher yields, enhancing returns. This risk is more significant for longer maturity bonds with lower coupons and affects pension funds and retirees who rely on fixed income streams. The practical implementation for individual investors seeking exposure to German government debt involves several approaches depending on location, account size, and investment objectives. European residents with brokerage accounts can purchase bunds directly through primary auctions or secondary markets. The Federal Finance Agency allows retail investors to participate in auctions through the debt register, known as Bundesschuldenverwaltung, which operates similarly to the U.S. Treasury Direct System. Investors establish an account, submit bids, and hold securities in electronic form. Secondary market purchases occur through brokers and provide immediate execution at current market prices rather than waiting for auctions. U.S. and international investors typically access German government debt through exchange-traded funds, mutual funds, or international brokers offering European bond trading. Several ETFs track German government bond indices, providing diversified exposure across maturities with low expense ratios, typically between 0.1 and 0.2% annually. These funds automatically reinvest coupons and rebalance as bonds mature, simplifying management. However, investors must consider the fund structure, whether it physically holds bonds or uses derivatives, how it handles currency exposure, and whether it trades on U.S. exchanges in dollars or European exchanges in euros. For institutional investors, including pension funds, insurance companies, endowments, and sovereign wealth funds, German bunds form a core component of strategic asset allocation. These entities typically operate with multi-billion euro portfolios and access markets directly through custodian banks, such as Clearstream or Euroclear, which provide settlement, safekeeping, and collateral management services. Institutional investors participate in primary auctions, engage in secondary market trading, utilize bonds for repo financing, and employ derivatives for duration management and risk hedging. The regulatory environment surrounding German government debt issuance and trading involves multiple layers of oversight. The Federal Finance Agency operates under the authority of the Federal Ministry of Finance and follows debt management guidelines established by Parliament. The issuance process adheres to transparent procedures with published calendars, auction rules, and results disclosed on the Finance Agency website. The European Union's regulatory framework, including the Markets and Financial Instruments Directive, known as MiFID II, governs bond trading, requiring pre-trade and post-trade transparency for certain transactions and imposing conduct rules on intermediaries. Tax treatment of German government bonds varies by investor jurisdiction. German residents pay capital gains tax on bond trading profits at a flat rate of 25% plus solidarity surcharge, totaling approximately 26.375%, while coupon income faces the same tax. Certain exemptions apply for small amounts under the annual savings allowance of €1,000 for individuals. Non-resident investors may face withholding tax on interest income depending on tax treaties between Germany and their home country, with many treaties reducing or eliminating withholding. U.S. investors report German bond income and gains on their tax returns, paying at ordinary income rates for interest and capital gains rates for price appreciation, with no German withholding under the U.S.-Germany tax treaty. Advanced strategies employed by sophisticated investors include duration management through tactical allocation across the yield curve positioning based on expectations of curve steepening or flattening, relative value trades comparing German yields to other Eurozone sovereigns, and volatility trading using options on Bund futures. The Bund future, traded on Eurex, represents one of the most liquid fixed income derivatives globally, with daily volume exceeding 500,000 contracts worth over 60 billion euros notional. These futures allow investors to gain or hedge exposure efficiently with leverage and lower transaction costs than physical bonds. Curve positioning strategies exploit changes in the shape of the yield curve, which plots yields across maturities. A steepening curve, where long-term rates rise faster than short-term rates, benefits investors positioned in shorter maturities or who are short long-term bonds. A flattening curve, where the spread between short and long rates narrows, benefits long-duration positions. The introduction of the 20-year benchmark creates new opportunities for curve trades, such as butterfly spreads comparing the 20-year to the weighted average of 10-year and 30-year yields. Relative value analysis compares German yields to French OATs, Italian BTPs, Spanish bonos, or U.S. treasuries to identify mispricing. The spread between Italian and German 10-year yields, known as the BTP Bund spread, has historically ranged from under 100 basis points during calm periods to over 500 basis points during crises. As of early 2026, this spread trades around 130 basis points, reflecting moderate risk premium for Italian fiscal challenges but confidence in ECB support. Investors who believe this spread will widen can short Italian bonds and buy German bunds, profiting if Italian yields rise relative to German yields regardless of overall rate direction. The interconnection between German debt issuance and European Central Bank policy cannot be overstated. The ECB's mandate focuses on price stability, defined as inflation near 2% over the medium term, but its actions profoundly impact government bond markets. When the ECB raises rates to combat inflation, short-term yields rise directly through policy rates, while long-term yields rise through expectations of future policy and reduced central bank bond buying. Conversely, rate cuts and quantitative easing compress yields. The ECB's holdings of German government debt peaked near 900 billion euros, representing roughly 37% of total outstanding German federal debt, a massive artificial source of demand that distorted price discovery. As the ECB normalizes its balance sheet through quantitative tightening, estimated to reduce holdings by approximately 200 billion euros during 2026, this creates space that the market must fill. The simultaneous increase in German issuance to 512 billion euros, while ECB demand falls, creates a net swing in supply-demand balance of potentially 700 billion euros annually compared to the peak quantitative easing period. This dynamic explains why yields have risen from negative territory to positive levels despite inflation declining, and it suggests that yields may remain structurally higher than the 2015 to 2021 period, even if inflation fully normalizes. The global implications of German debt dynamics extend through multiple channels. First, higher German yields translate to higher borrowing costs across the Eurozone, particularly for peripheral countries whose spreads widen during stress. This tightens financial conditions, slows economic growth, and constrains fiscal policy, especially for highly indebted nations like Italy, with debt-to-GDP ratios above 130%. Second, European yields affect global capital flows as investors compare returns across regions. When German yields rise relative to U.S. treasuries, capital may flow from the U.S. to Europe, strengthening the euro and weakening the dollar. with cascading effects on trade balances and monetary policy in both regions. Third, German bonds serve as collateral in global repo and derivatives markets, so changes in their availability and pricing affect liquidity conditions worldwide. The case study of Japan provides instructive parallels and contrasts. Japan's government debt exceeds 250% of GDP, by far the highest among developed nations. Yet Japanese government bond yields remain below 1%, even for 30-year maturities as of early 2026. This occurs because the Bank of Japan maintains yield curve control, actively intervening to cap long-term rates, and because domestic savings are immense, with most JGBs held by Japanese institutions and households. Germany differs in having much lower debt, no yield curve control, and significant foreign ownership, estimated at approximately 50% of outstanding bonds. These factors make German yields more market-determined and responsive to global conditions than Japanese yields, but also more volatile. The United Kingdom offers another comparison following the September 2022 gilt crisis, when the announcement of unfunded tax cuts triggered a bond market rout, with 10-year gilt yields spiking from 3.5% to over 4.5% in days, forcing the Bank of England to intervene with emergency purchases. This episode demonstrated that even developed nations with reserve currencies can experience sudden loss of market confidence if fiscal policy is perceived as reckless. Germany's commitment to fiscal discipline through the debt brake, despite current debates about reform, provides credibility that anchors market expectations and keeps borrowing costs lower than comparable countries with weaker fiscal frameworks. Looking ahead, several scenarios could materially affect the German debt outlook and Bund yields over the next 5 to 10 years. A scenario of sustained moderate growth, inflation stabilizing near 2%, and gradual fiscal consolidation would likely maintain the current yield environment, with 10-year bonds in the 2 to 3% range and 20-year bonds yielding 2.5 to 3.5%. This baseline scenario assumes successful navigation of geopolitical tensions, continued Eurozone cohesion, and effective ECB policy normalization without triggering recession or financial instability. An alternative scenario involves a return of inflation shocks from energy transitions, geopolitical conflicts, or demographic wage pressures, forcing the ECB to maintain higher rates for longer and pushing Bund yields toward 4 to 5% across the curve. This scenario would significantly increase German debt service costs, potentially necessitating fiscal adjustment through spending cuts or tax increases, and would strain peripheral Eurozone countries, possibly reigniting sovereign debt concerns reminiscent of the 2011 to 2012 crisis. Higher yields would benefit income-seeking investors, but impose capital losses on existing bondholders and slow economic growth through tighter financial conditions. A contrasting scenario features economic stagnation or recession, driven by weak productivity growth, aging demographics, or external shocks, leading the ECB to cut rates back toward zero and potentially resume quantitative easing. In this scenario, Bund yields could fall to 1 to 2%, compressing returns for investors, but reducing government borrowing costs. This environment would challenge savers, pension funds, and insurance companies struggling to generate returns sufficient to meet liabilities, potentially requiring higher contribution rates or reduced benefits. The long-term structural factors shaping German and European debt markets include demographic aging, which increases public spending on pensions and healthcare while reducing the workforce and tax base, climate transition costs estimated in the trillions of euros to achieve carbon neutrality by 2050, digitalization investments in 5G networks, artificial intelligence, and cybersecurity, and defense spending increases in response to geopolitical tensions. These pressures suggest sustained higher government borrowing relative to historical norms, meaning larger issuance programs and potentially higher yields required to attract sufficient demand. The introduction of the 20-year benchmark positions Germany to meet these financing needs efficiently while providing markets with the tools to allocate capital across the duration spectrum. Financial discipline for investors navigating this environment requires realistic expectations, diversification, and active risk management. Realistic expectations mean understanding that German bonds, while safe in credit terms, offer modest returns that may barely exceed inflation over time. The historical equity risk premium, the excess return of stocks over bonds, has averaged approximately 4 to 6 percentage points annually over long periods, and this premium exists precisely because bonds are safer and less volatile. Investors seeking higher returns must accept equity risk or credit risk through corporate bonds, emerging market debt, or alternative investments, each carrying distinct risk profiles that require thorough due diligence. Diversification across maturities, currencies, and asset classes reduces concentration risk and improves risk-adjusted returns. A portfolio holding only long-duration German bunds faces significant interest rate risk and inflation risk. Adding shorter maturities reduces duration, while including inflation-linked bonds provides explicit inflation protection. Diversifying into U.S. Treasuries, UK gilts, Japanese JGBs, and investment-grade corporate bonds spreads risk across issuers and jurisdictions. Combining fixed income with equities, real estate, commodities, and alternative investments creates a balanced portfolio with lower overall volatility than any single asset class in isolation. Active risk management involves monitoring portfolio duration and adjusting based on interest rate outlook, rebalancing periodically to maintain target allocations, using stop-loss disciplines for trading positions, and stress testing portfolios against adverse scenarios such as sharp yield spikes or currency moves. Professional investors employ sophisticated tools, including value-at-risk models, scenario analysis, and Monte Carlo simulations to quantify potential losses under various conditions and ensure that risk exposures remain within acceptable boundaries defined by investment mandates and risk tolerance. Germany's €512 billion issuance program and the introduction of the 20-year benchmark represent more than technical debt management decisions. They reflect the evolution of Europe's fiscal architecture as the largest economy adapts to changing strategic priorities, normalizing interest rate environments, and the structural funding needs of a developed society facing demographic change and global competition. For the global financial system, German bunds remain the cornerstone of European fixed income markets, providing the risk-free rate benchmark, the preferred collateral for financial transactions, and a safe haven destination during turbulent times. The depth, liquidity, and transparency of the German government bond market make it an essential component of diversified portfolios for institutions and individuals worldwide. Understanding the drivers of German debt issuance, the mechanics of Bund markets, and the factors influencing yields equips investors with the knowledge to make informed decisions, manage risks effectively, and navigate the complex landscape of sovereign debt investing in an era where macroeconomic and geopolitical forces shape returns in profound ways. The path forward for German debt and Bund yields will depend on the interplay of fiscal policy choices, central bank actions, economic performance, and external shocks, requiring continuous monitoring and adaptive strategies from all market participants who recognize that in the interconnected global financial system, what happens in Frankfurt and Berlin reverberates from New York to Tokyo and everywhere in between.